The inverted hammer candlestick pattern, or also referred to as an inverse hammer, is a single candlestick that appears on the chart when there is pressure from buyers to push an instrument price higher. In general, this candlestick is formed when buyers begin to gain confidence, and it is often seen at the bottom of significant downtrend as an indication of a potential bullish reversal. The top wick indicates that the price has risen as a result of buyers push the price higher, while a lower wick indicates that sellers kept the price lower by preventing the price from rising further, and the market settles at a higher price when the buyers is too strong as opposed to sellers. An inverted hammer indicates a market is experiencing pressure from buyers, and it warns traders that prices are likely to revert after a bearish trend. In order to confirm any potential signal, it is important to remember that the inverted hammer candlestick should be viewed in conjunction with additional technical readings. Therefore, one of the simplest and reliable ones is by looking for inverted hammer that appears in strong trends after a retrace to the level of support, where it has a high probability that the price will reject and move in accordance with the prevailing trend. For the entry, it is important for traders to wait for the candlestick pattern to complete before taking any trading decision. Traders can enter the trade immediately once the candle closes. The stop loss is placed just slightly below the low of the inverted hammer, and the ideal place to set the profit target is at the previous swing point, and in case there is a breakout with increased momentum that could lead to a long-term move in the direction, then traders can consider using a trailing stop to protect gains and continue to profit as long as the price moves in favor.